I think we're dealing with the consequences of, 20 years or more of reckless Fed policy. Really started in earnest in 2001, 2002 timeframe when Greenspan was, at the helm and he slashed interest rates down to 1% after the dot-com bubble burst. Although the policies, predated that, during the 90s. But when we went down to 1%, that really started the housing bubble. That popped in 2008, and then we went to 0% interest rates in QE following the financial crisis. So the Fed flooded the economy with inflation to paper over all these problems and bail everybody out, all the while claiming that we didn't have enough inflation because somehow these government measures showed that it was under 2%. And they claimed that 2% was their target, which was a bunch of nonsense. But they used the fact that they could pretend inflation was under 2% to claim it wasn't high enough. And then they kept printing money. Well, those consequences are now on us, right? The inflation chickens have come home to roost. And the Fed has, belatedly raised rates now. They're back at 5.25, and they expect that they can reverse 20 years of inflation with a year of rate hikes. It's not going to happen. We still have massive government spending and deficits. The Fed's balance sheet is still enormous. There's a lot of inflation already built into the pipeline. It's here for a long time. And in order to, get out in front of it and bring inflation down, we're going to have serious cuts to government spending, consumption. Everybody's going to have to start saving again and producing more and spending less. But we're not pursuing any policies that'll make that happen. But what the markets just don't understand is that the Fed can't just magically put this inflation genie back in the bottle, that it's brought a knife to an inflation gunfight and it's going to lose. And inflation is going to be well north of 2% for the foreseeable future. And that has major implications for the bond market, stock market, the economy, the dollar, gold. Everything is going to change when that realization finally hits. The Fed indicated that there may be not much left to the rate hikes, but the most recent minutes suggest that, they're having some second thoughts about inflation. So we'll see. But, there's a limit because we have so much debt. I mean, just look at the federal government as one example with a $32 trillion national debt. They can't finance that at 5%. I mean, it's already gone up now on an operating basis right now. Interest on the debt is already the third biggest line item in the budget. Number one is Medicare. Number two is Social Security, and then interest on the debt. It's bigger than national defense. Defense is now number 4. But if interest rates stay where they are for another couple of years, interest on the debt's going to be number 1. And where's the money going to come from to pay all that interest on the debt? Well, they're going to borrow it. Well, from who? And then the Fed's going to print it. That means even more inflation. Well, it hasn't even really started to fall yet. I mean, the dollar index is still above 100. So, people still have confidence in the dollar. It doesn't make any sense to me that they do. That's one of the reasons gold hasn't taken off. It's still around 1900. I mean, people still think that the Fed has got this under control. Well, I think when it peaked at around 9, it was probably around 18. And so now, according to the government, it's around 3, which means it's around 6. So we have had a decline. Again, we're just talking about the effects of inflation, which are consumer prices. But 6 is still a lot of inflation. Yeah. And I don't think it's going to bottom out here. I think we're headed back up, maybe even higher than the 9, which means, above 20 in reality. Yeah, the money printers are going to be revved up. I mean, they'd already did that, right? As soon as we had a bunch of banks fail, those first 3 big banks or 4 banks, you saw a $300 billion jump in the Fed's balance sheet in a week, right? The Fed printed a lot of money. And then after the kind of crisis backed off for a bit, they went back to quantitative tightening. But the next sign of trouble, if something bad happens, they're going to do that again. And we could be very close to another, big shoe dropping. So the housing market is going to have, forces that are competing with one another. Supply could be restricted by the fact that nobody who owns a house wants to sell because they don't want to give up their low mortgage. So people will stay in the house even if they don't have equity. But the fact that so few properties are for sale helps keep the prices higher. Builders haven't been building as many homes because the construction costs are very high and their financing costs, because most builders have to take a construction loan to build a home, and so they're a lot more expensive. So you're not getting a lot of new houses being built, and a lot of the existing homes are not for sale. Meanwhile, rents are really soaring again because people can't afford to buy because the prices haven't come down yet, but the mortgage rates have gone way up. So that's kind of keeping a floor underneath home prices. Now, if we get a huge collapse in the economy, we get a lot of people losing their jobs, then even if you have a 3% mortgage, you might not be able to pay it if you no longer have a job. So at some point, we could see a lot of houses come on the market, in which case the prices are going to tank because people can't afford to buy the homes at these interest rates. The only reason people could pay those crazy prices, in years past was because they got 2%, 3%, 4% money. We're almost at 8% now. I mean, we're north of 7.5%. So we get up to 8%, 9%. It's a whole new ballgame in real estate. And people, aren't old enough to remember, but the peak in mortgage rates in 1981 was 18.5. So it's happened before. Again, this is all about putting a Band-Aid on a cancer and just hoping nobody notices, that it's getting worse. And what you got to do as an investor is say, okay, this is not going to end well. And what are you going to do to protect yourself? And I think the big casualty is going to be in the value of the dollar, because we're just going to print them and print them and print them, and the value of dollar-denominated assets. I mean, the whole U.S. economy is in major trouble, and people have to do something. That's what I'm doing, with my clients, is getting them out of Dodge, and I've been doing that for years. So I was clearly early, but I know I'm right, and the problem is all these problems that I saw years and years ago, they're even worse now. They've just gotten bigger. None of the problems have been solved. We just kicked the can down the road and let the problems get bigger. So it just means the rationale behind what I'm advising is stronger. And the consequences of not being prepared in the way that I'm encouraging people are even greater. So people have to do it. And that's getting out of dollars. So, we're building portfolios of foreign dividend-paying stocks around the world in countries that are in better shape fiscally, monetarily than the U.S., where you can get, real returns on your equity investment and have a hedge against inflation, but also specifically investments that will benefit from higher inflation, the realization that inflation is going to be higher, and the appreciation of commodities and other things that do well in an inflationary time. So we have a lot of investments that are focused more on on oil and gas, on agriculture, on energy, and of course, precious metals. I think the major beneficiary of the demise of the dollar, of de-dollarization, is going to be gold, because I think gold is what's going to replace the dollar as the primary reserve monetary asset for foreign central banks. Everybody thinks, well, the dollar's reign as the reserve currency is going to last forever because, there's no other currency that can take its place. I agree. There are no other currencies that should supplant the dollar as the reserve. We don't want a currency as a reserve. We want real money as a reserve. We don't want to back up one fiat currency with another fiat currency, because there's nothing backing up that fiat currency. All these currencies have to be legitimized by being backed by real money, and that is gold. And, prior to Bretton Woods, every currency was backed by gold. And in fact, even after Bretton Woods, every currency that was backed by the dollar was backed by gold, because the dollar was backed by gold. Not only was it backed by gold, it was redeemable on demand in gold. So we didn't stop that until 1971. It was supposed to be temporary, but it ended up being permanent because it's now over 50 years. So I think the world is going to go back to what existed before 1971, which is that all the currencies are backed by gold. And to do that, the price of gold's got to be much higher.